What a wild trip it's been from where we were at the beginning of the year to the tariff-induced sell-off to right back to market highs. And it's really been crazy. And we talk about how our clients can participate in that. And that really comes to portfolio construction, Brian. And we spend a lot of time talking about that.
When you think about portfolio construction, we want to put the plan first. So what is the goal of the client? What's their risk capacity, their risk tolerance, and then to align the portfolio with that plan and their willingness and ability to take on risk. And when we look at what has happened this year so far, you see the S&P 500 down nearly 20% and then rebounds back. We're above like 5% up on the year.
Isn't that one of the fastest recoveries on record?
It is. And when I look back at all of the market corrections and bear markets, so a 10% decline or more, and then a 20% decline or more, going back to 1950, this was the fastest in terms of the descent, but then also the rebound. And that's really surprising, the strength of the rebound. And I think it was just because the mood swings of investors around the tariff announcements in the Rose Garden, right? Taking that as though this is the way it's going to be. All of a sudden you had these major Wall Street firms saying, oh, we're going to have a recession. And I think what they failed to realize is that that wasn't the end goal. The goal wasn't to say these are the rates that are going to go into effect. It's like, okay, these are the rates that could go into effect unless you play nicely. That's what we did on the investment committee, is looked at it and like, I think this is probably a bit of an overreaction on the part of the market, basically saying that the certainty of a recession, we're like, no, it's not certain. This is not a done deal. And that's, I think, why we had the nice, strong recovery here.
We're starting to see things that are levered to taxes and trade are beginning to rally.
Exactly, because turning down the temperature or the volume of the rhetoric around will they, won't they, will there be deals, won't there be deals? Now with that clarity, those companies that had that cloud overhanging them of the uncertainty, that uncertainty is beginning to clear. And then that shows up in price action.
And so we look at a number of indices and we measure ourselves against those, right? And so the S&P 500 is one. ACWI is another. That's the All Country World Index. And we look at what is doing well and what is not. And that's when we talk about portfolio construction. We say, all right, here's our core on the inside. And then tactically around that, we can overweight or underweight based on the facts and circumstances. And so we drive that bus, if you will, and make those modifications for our clients. The reason why we pair the financial plan with the investment plan, because they need to work in synchronicity.
This idea of having a globally diversified portfolio. So you mentioned ACWI, right? That's the All Country World Index, because it is a big world out there. Investment opportunities aren't just in the United States. And we're especially seeing that this year to date, where you see non-U.S. markets dramatically outperforming U.S. markets. Even though U.S. markets are up, non-U.S. markets have actually been sort of the better place to be. And I think it really stresses the importance of that global diversification.